Hey guys, welcome on in. We are going to be doing a real cool webinar here. Going to give you just a second to filter in. Welcome, Danny. Good to see you, brother. RB, nice to see you here for the first time. Yeah, let's see how it goes. I think it'll go well. All right, Talk. Good to see you, brother. Good to see you. And Mr. Josh Smith. Let's go, baby. Let's go. All right. So, we're going to be talking about one of my favorite indicators, and it's not even just an indicator. We're going to be really building off of this indicator, talking about multiple strategies we can use. The great thing about this indicator is that it's very good at giving you indicators for basically repeatable setups, very common setups that you see throughout the week, sometimes throughout the day. So I think that it's really, really valuable for that reason. It's something that I use to take multiple trades each week. Used it to hit a real nice trade today, used it to hit a nice one yesterday. I didn't listen to the market profile on my second trade of the day. That was a loss. I should listen to my system more. It's good stuff. Let's hop right into it here. So, first off, if you're not familiar with the basics of market profiles, that is okay. We're going to be going over the basics briefly. If you want some more context, some more kind of, just information on the more rudimentary aspects, I do have a full webinar on it. You can go ahead and find that on our Trade the Pools YouTube channel. You can go to the playlists and you'll see all of my webinars right there. And you can just scroll down. It's maybe 5 or 6 down. And you can find that one. But that being said, if you don't know, don't worry. I think you can probably follow based on the basics we're talking about here and then look back as needed. But I really wanted to delve in deeper to this because there's so many when I was doing the first one, I was like, there's so many things I want to talk about that I just don't have time. And then I was doing this one and I was like, I still don't have time. So this is going to be a 3-parter. We'll call this, all right, it's not advanced, it's intermediate. And then the next one will be advanced. How about that? So we are going to hop right on in. So what we're going to be learning today, let me get my face out of the way. We're going to be learning about the basics real quick, just going over the basics of the market profile. We're going to be talking about all the key components of this indicator and what they all mean. And then we're going to get into how to use them. We're going to be talking about some pattern recognition, some institutional activity pattern recognition. So we're going to be finding kind of the footprints of these institutional moves that help us kind of ride on their coattails because that's our biggest strength as retail traders. We do not have the strength to move market. That's okay. We can watch, and when somebody else steps in with that strength, we can ride that wave. And that's our strength because we can pivot. We can get in and out. They have to build the position and then eventually launch it. So while they're loading, we can be cognizant of what they're doing. And when it's time, we can get in and catch that clean move without getting, with very minimal drawdown. So that's why I think it's important to watch these institutional patterns and why I think this is a great tool to do it. So we're going to be going over volume distribution analysis. So it's one thing to know where the shares traded at a given level on the chart, but it's another thing to kind of delve a little bit deeper, look underneath the hood, and essentially dissect where that or what that volume is actually doing at these levels. Is it primarily buyers, sellers? What does that kind of tell us? So that kind of stuff. We're going to be going over a few high probability trade setups, how to identify them and how to actually trade them. We're going to be talking about value area dynamics and trading strategies. So talking about ranges, talking about where to buy in these ranges, where to sell in these ranges, and kind of the dynamics that occur within these ranges. We're going to go over some real world examples. And then, you know me, I love doing Q&As. So you can start asking questions whenever you want. I will try to get to them as we go. But if there's any I miss or if they're not super relevant to what I'm talking about at the moment, we're going to talk about all those at the end. So thank you so much for being here, guys. I appreciate it. Yeah, 50 people already. Awesome. So yeah, welcome on in, guys. And yeah, let's get into it here. So let's refresh here. Let's do a little brush up. One of these days, I'm gonna remember to not put words where I usually put my face. There we go. So here are the foundational elements of market profile trading. So you have a tool called the time price opportunity, the TPO. And this is where it might look like a volume profile, but it has letters instead of the just bars. We are going to talk a little bit about that, but I want to focus on the market profile because they're very similar. They're not identical, but they are very similar. And the market profile is available basically for every platform. The volume profile, market profile. It's not quite the same as a TPO. It doesn't give you all of the same information, but it's really close and it'll serve the purpose for what we're talking about here. So the point of control is going to be the most important thing that we're probably talking about here in terms of terminology. And it's pretty simple. The point of control is just the price level where the highest volume has been traded. So don't worry if this is confusing. We're going to have lots of examples. I am getting better about adding more examples because I know a lot of people are visual learners. I think it helps more. So the point of control, price level with the highest volume, and then you have your value area. So the value area is the area of the daily price action where 70% of the volume trades. So there's going to be 15% of volume on the top end of that, probably like top wicks or very low volume trading over the range. And then there's also going to be that on the bottom end. But that 70% in the middle, that's what we really care about. And we're gonna be watching those levels. And we'll talk about why. So there's the initial balance or the IB. So this is going to be the range of the first hour of trading. And this is going to be very useful for kind of gauging the relative strength of something out of the gate and gauging what it's going to do after that opening range is set. So there are lots of trades we can take off of that opening range. That's important to know. And then we're going to be talking about different profile shapes as well, because the different profile shapes are very, very core to this system. We're going to be talking about the P shapes. If you just caught me on Trader TV, then you probably heard me go over that SPY trade. We're going to be going over that one and talking about how I use that P-shaped volume profile to really juice returns and get a very, very tight entry, with very minimal risk. So that's the P shape. There's also B, which is bearish, and D, a balanced one. So we're going to talk about all three and how to trade each one. So market profile, it's really cool because it shows you where the price has spent time and then how much volume is traded and when that activity has occurred. So all very crucial components to getting the information we're looking for to define or to, what's the word I'm looking for? To inform our bias on directionality. So let's talk about the institutional footprint, because we always want to recognize this because that's the smart money. That's the big money. And if we can figure out what they're doing, we're going to do okay. So there's some characteristics in terms of volume that you can look for these institutional footprints. You want to look for the high volume at key levels and without significant price movement, because this is going to tell us that level is basically absorbing and it's going to be a pivot. So that's something we look for. If institutions are stepping in to buy at a certain level, we might see high volume as people continue to sell into it. And they're sitting there with open orders saying, yeah, fill my bid. I'm happy to buy this here. This is where I want to buy it. I've been waiting for this. So then the sellers exhaust themselves, and then the shares are transferred from these weak hands to the strong hands of the institutional holders. And that's what we're looking for to catch these big moves. So volume spikes at the support and resistance breaks. Like I said, very, very important to watch what they do there. And if you've watched any of my other webinars, one of my big things is you always want to look for confluence between effort and results. So let's talk about what that means really quickly. So when I say effort versus result, I'm talking about volume versus price action. The volume is the effort. That's how hard they're pushing it in one direction or the other. And then the result is, can they actually accomplish a significant move? So if you want the stock to go up through your level, you want to see a surge of volume, which is combined with a surge in the actual price. If you just see the volume pushing, but price cannot, that's a sign that maybe there's an institutional seller there, and you're trying to buy into somebody who has a whole lot of inventory up here, and they're trying to just sell it to you, and they're happy to sell it to you because they're going to buy it back cheaper. So that's kind of the basics of recognizing institutional footprints. And how I want you guys to look at this is it's like a marketplace. Professional traders, whether they're institutions or whether we're talking market makers, it's all about acquiring inventory for cheap and offloading it for a nice premium. And so if we view price action like that, it'll start to make a lot more sense, I think. All right. So let me catch up with my notes here. Okay, so there are some time-based clues here as well. We talked about what we're going to be watching for the volume there. And then let's talk about the time as well. So there's going to be a concentration of activity during specific sessions. So this is the high volume open. This is the high volume close. And these are where you're going to get the moves that stick the most. This is when institutions are going to be trading with significant size, and often when you will get range breaks or breakouts or rejections. But the important thing here is that this is where the most of the volume is traded, and this is where smart money is often traded, in the beginning and the end. And so if you're a day trader, I'm sure you've experienced, the afternoon, the lunchtime lulls where just moves won't stick. The setup looks good, but it doesn't follow through. And usually that's because there's no volume there. It's much lower volume, when Wall Street's out to lunch. So we want to time our trading to be aligned with this high volume, because it makes the move stick, and it makes things easier to read, and it makes things easier to profit from. So that is a key component. And we also want to think about the overnight inventory. Like I was just talking about, it's like a store, right? It's like a wholesale store. So yesterday, when everybody was freaking out, when SPY was puking its guts out down to 655, 656, smart money, they were saying, oh, it's a fire sale. I need more of this. Everybody needs more SPY. I mean, it's just about how much you want to pay for it. So fire sale, they're in. And what did it show? It showed that it did not spend very much time down there because it got bought up really quickly. And then most of the time that it spent was near the high of the day, or at least in the top half of that value area. So the top half of that 70% of the meat of the volume. So that's a really good sign, right? That's showing that when it was offered at a discount, it got bought up quick. The market was saying, hey, we're calling BS. That was too cheap. We can buy it there and sell it higher. We know we can. So they loaded the boat. That's their inventory. And then you have the overnight move, people riding that wave, riding that P-shaped volume profile. And we got that beautiful pop in the morning, right? What did we see though? Well, big money just bought a ton for cheap. And it's the very next day, and it's at a nice premium. So what did they do? They sold it off real nice, all the way back down to our key level of support from the previous day. So these are where these patterns are very repeatable. You can just keep finding these, and you can keep profiting off of them. And it's no coincidence that it does this, because it makes logical sense, right? They bought cheap, they got the opportunity to sell at a premium, and they have an opportunity to buy cheap again. So that's just good trading, right? So so we wanna try to trade in alignment with that as much as possible. So let's talk about the profile signatures real quick. And I'm going to whip out my handy dandy pen here. Let's see. If I draw on this, can you see? No, I have to draw on the actual page. Okay, so let's talk about the P shape first. P shape is going to be pretty simple. A P, and then you'll have the point of control right about there. Then you'll have your value area low near there, and your value area high right about there. So there might be some trading up in here, but not very much volume. That's going to be like retail chasing things and then getting bagged. But this is going to be the kind of basic shape of this P profile. And we want to look for this if we want to see continuation, bullish continuation, the next day. Then you have the B shape, and it's basically the same thing, but it's just going to be on the other side. So if the range of the day is primarily trading shares down here, what does that tell us? It tells us that the average participant here is engaging with this in the lower half at a discount in the range, and it's not getting that sharp move, that rejection of the levels, that we saw with that example yesterday, where it whipped down and then whipped back up, and then that's where it really liked to be. It's like it's taken a little trip down here, but now it's back home. So if you have a B-shaped profile, back home is near the bottom of the day, and the more price is accepted in the lower half of the range, the more likely it's going to seek expansion below that range. So that's going to be your B shape. And then what you'll see a lot, and what a lot of people have trouble trading, are the D shapes, where you have your value area high, value area low, and your point of control. But it's not going to be easy or as easy to trade this in the same way as one of these. And we're going to talk about why that is as we go forward here. But right now, I just want you to be familiar with the different shapes so that when you see them on actual charts, you'll know what we're talking about here. All right. Oh man, my drawings are still there. Let me erase those. There we go. All right, let's get into the examples here. Let's get into the fun stuff, guys. So we are going to be having some charts to accompany all of these concepts as I introduce them. This is kind of going to be an information dump. So we're going to get through as much as we can and keep asking questions. If you got them, we're going to work through them and we're going to figure this out together because it's really worth it to sit with these ideas and really try to understand them as best as possible. It's one thing to kind of learn a concept, but it's another to really like internalize it to the point where it's not taking up all of your processing power to analyze it from that lens. So we want to get you guys to a place where you're not sitting there stressing about what's going, like, you know, what profile shape is forming. We want you to just be locked in saying, okay, this is the setup. We know the technicals. We know the reasons why we can expect a certain move and to just hop right in. So let's talk about what we got going on here. This is yesterday's price action, and I cut off what it did, but you guys know what it did. But this is the big P shape that we were talking about. So despite price spending a decent amount of time, not necessarily time, but it formed a decent range down here, but not many shares traded down there. Most of the shares traded right up into this neckline. And that is the area of interest that we bought off of today when it came back down there. So let's talk about a few things here. The components of a volume profile are going to be the buying volume versus the selling volume. So that is this green versus the red on the profile. And that tells us, pretty simple, right? How much of the volume traded was buying and selling. How do we know that, first off? Well, we can tell because of how aggressive the orders are. If they're filling at ask, that's somebody saying, hey, get me in, get me in, get me in. If they're filling at bid, that will often be a sell. So this is the basic concept here. There are some why are words hard? Anyways, this is what you really need to know. That's the point. It's been a long trading week, guys. I feel like I say that every week. We have a stressful job, but the good thing about systems like this is it helps take a lot of the weight off our shoulders, and we can just rely on what's tried and true. So getting back to this, we have the buying volume versus the selling volume. We also have volume gaps, and these are areas of low acceptance. So when you have a gap, like see right below the P there's a little gap, and sometimes they're more distinguished, more noticeable. Like see this big gap up in here. So these are areas of low acceptance. What that means is that when price traded through these areas, it was not a balanced auction. It wasn't buyers and sellers equally duking it out like we see when there's a consolidation or a range, a tight range, a chop area going sideways. It's just straight knives down or straight rockets up. And that is an imbalance of buyers to sellers or sellers to buyers. So that's what I mean when I'm saying it's an area of low acceptance. What this means for us is that these are areas that can cut through really quickly. So if we get a back test of our point of control and we find buyers there, we can shoot up into that area of low acceptance and just get a really nice clean move. And that's what we're all after, right? Nobody wants to get caught in a chop box. It just doesn't feel good. So that's why we look for volume gaps and also volume nodes. So the volume nodes are the other side of that equation. And those are going to be your high acceptance areas. Like I said, these are going to be areas of consolidation, of basing, of either accumulation, if it's going to eventually break up, or distribution. And it's up to us to figure out, given the context of where this range takes place in the larger picture, as well as what price is doing in this range. That's how we're going to inform our bias about which way the range is going to break. So we have a lot to talk about for those. The volume nodes, like I said, just high acceptance areas there. And then there's also the concept of volume migration. And this is what I'm kind of talking about when I'm saying all right, the P shape today is going to inform my bias of price action tomorrow. So if we are in a nice trend, which we'll have some examples in just another slide or two, if we're in a nice trend, we will see just a continuation, a stair-stepping action of this migration of the volume profile. It's just going to keep migrating on up, because the majority of the shares trade up in the P, and then it breaks out, moves to the next range. Majority of shares will trade up in that P, and it'll just keep on finding acceptance higher and higher. What we can also consider is, I'm sorry, I got distracted because Extraordinary Cave Trader. Good to see you in there. And this is, good point. And I think this is telling us something about where we are in the market right now. Extraordinary Cave Trader is saying, today it wasn't chopping or trending longs and shorts. It was zigzagging long and short, right? You got some really good moves on both directions. So if you're a snappy trader, man, you could make a lot of money today. I had one really good trade and then I chopped myself out trading in the afternoon session. It was not the best day for me, but we live and learn, and it's great content for you guys, if nothing else. So learn from my pain. Let's see what else we got. DJ 2AM, thank you, dude. You are the man. I appreciate you from the start. One of the OGs. Yeah, thank you so much for everybody who keeps coming back. I appreciate that. But let's stay on topic here. Let's get back into it. Alrighty. So what do we got here? We got the first part of some value area dynamics that I want to talk about. So remember, the value area that's what contains 70% of the volume, and on the chart it is defined by this little blue dotted line and this little blue dotted line. You can, of course, change it on your own, but it's important to have these marked because they're going to give us really actionable information. So as you can see, just in this price action here, and we can go into other charts too that are a little more in depth to get really granular for this. But just for the basic premise, you can see that when price on the intraday level wicked above this volume area high, it gave you some really nice opportunities to trade it back down into the point of control and potentially much further, like we saw in this case. So these are some very reliable setups, and we're going to talk about this in detail, but I just want to put it on your radar here because this is a very common dynamic. If you are in a relatively contained range, so a D-shaped profile, or it could be a P-shape like today, but it isn't ready to break out yet. If that's the case, then what you're going to see is some really nice opportunities to fade these value areas back to the point of control. And the idea here is that we're not expecting a big breakout on a deep profile. So our trading plan is going to be mean reversion. We are going to fade the exuberance and the panic that we might see on the tape. So what this will look like is watching for weakness when you're above the value area high. So you don't want to just immediately short it when it's above the value area, because we could be misreading and it could be finding price acceptance above the range and expanding. So first we need to make sure that it's not, and that will be looking for weakness in this zone above the value area high. Once we've established that, you can pick your system. I use my triggers system, so it's very defined for me. Okay, we're uptrending over the value area high. We're going to be riding our 1 minute trigger up. When we lose that, back test it and reject it above the value area high. That's my entry. Let's see. Got some questions here already. Mohammed asking, can you arrange a lecture on footprint charts? That is interesting. Footprint charts are cool. I don't know if my subscription has them. I'll have to look into how to get access to them and share them with you guys. It's not something I use every day, so I'd have to learn about it. I don't want to teach you something I don't know, but I'm going to put it on the list and see if I can look into that. Thanks for the suggestion. Cool. So let's get on into the next one here. And the last point I wanted to talk about was so this value area of 70%. This represents the fair value range, and you'll hear me talking about fair value a lot. And I know it can seem like an arbitrary concept because it kind of is, because it depends on the context. Fair value could be referring to the fair value in an intraday range. It could be referring to the fair value of the entire price history of the chart. But in the context of our lesson today, we're referring to the fair value of the current time frame, so intraday here. So when we are when we are talking about this, remember, we're thinking about it like a business, about buying inventory cheap and selling it for a premium. So when there's an established range, like this swing high where it rejected the value area, or I'm sorry, let's look at the first one here. So it's a swing low that rejected the value area low, came right back up, swept out the value area high. This is a nice established range. And now what we want to do is we want to see what price does when it trades within that range. So if we have a nice range and we're in a nice bullish uptrend, we probably want to see buyers step in when it's at a discount again. What does that mean? Well, when it's under the 50% fib or the halfway point of the current established range. Pretty simple, right? If you think about it, it actually is really simple. We have a range. It's just where the market caught, where the market rejected. So now we're digesting that little movement. And how that looks is that it will basically, the range will be swept so that loose hands will be shaken out. People who are just looking for that initial pop above the value area high, they're going to get stopped out. And those shares are going to transfer to longer term traders with more conviction. So if they are, if they're bullish, then you'll see that accumulation and the sellers kind of dry out, which is what we saw today. And that's why we're looking for that kind of institutional footprint there. But the basic concept is just price came down, and when it was under the 50%, it gave the big yeehaw. It puked it. So that was a tough one. It ran the stops here hard, and that's why it's important to have a higher time frame context, because we knew that was a level of interest that we'd likely want to revisit. But when it confirmed there, it gave us a really nice, pretty fast indicator that it wanted to zip back up in there with the speed and velocity in which it retook this low. So that's another trade setup that I trade constantly, and that's a failed breakdown. This is one of the setups that you only need this to be completely on. You could only trade failed breakdowns your whole life. And honestly, if I only traded them, I'd probably make a lot more money because they're so reliable. And it's just the basic mechanical concept of, hey, we have a level, price lost the level and then reclaimed the level. All of the sellers, they exhausted themselves, and now they fumbled the bag essentially. And it gives us a really nice level where bulls can step in and push off. And the most important thing for me is that it defines your risk, because we already ran the stops. We already sought after liquidity on the sell side. We reached down and we found buyers, and we came back up to reclaim a level. We shouldn't revisit that. If we do, we're wrong, and that's totally fine. That'll happen 20 to 40% of the time. But we do this every day and we make money. So all about replicable setups here. Let's get into a little more dynamics here. So the types of value areas that I want to go over are, I kind of classify them in a few ways. So you can have the overlapping value areas, and that's going to be where essentially they're overlapping day to day. And these are going to be usually kind of areas of a high volume node, or a price digestion, price acceptance, as we'd refer to it. This is an area where price is kind of at an equilibrium. There are buyers, there are sellers, they're trading back and forth, and we're waiting to see who wins that battle, essentially. So you have the overlapping ones there, and they can be continuation signals if we do get like confirmation from that level. And then you also have the non-overlapping value areas as well. And this could be a sign of trend change. And we're going to get into examples and explain why. But that is one concept here. Another is expanding volume areas versus contracting. So if you have an expanding pattern in any form, what is that telling us? What is it telling us? So it's showing more volatility. It's showing less coherent structure and more signaling more either fear or just there isn't an established fair value, so to speak. It's kind of influx, and it needs to kind of find price acceptance at a certain level before it tightens up. So in general, increasing uncertainty, expanding value areas, they are a sign of, well, probably some volatilities underway here. In general, volatility likes to go down, not always, but so that's something to keep an eye on. If things are expanding, for example, if you're trying to buy a dip on a stock and it's basing, but that base is expanding on you, that's kind of scary, right? Because you want to see it tightening up. You want to see it getting more coherent if it's going to turn around. So that's just something to keep in mind. On the other side is contracting value area. And this is going to be the opposite side of that coin. That's going to be showing a consensus, a building consensus where buyers and sellers, they're in this range and it's just tightening and tightening. What that tells us is they're coming to an agreement. You know, it's a beautiful thing. When bears and bulls agree on something, you know, so they agree and they find a fair value, and then eventually there will be a shift, and one of them will win that battle, and then that will inform the direction of the break. So these are some really important concepts, and they're very widely applicable. They're not just for trading a volume profile. These are just things that are inherent to price action. You know, so really good to kind of just internalize these concepts, and then you'll start seeing them on the charts. So got a few more value area dynamics, then we can move to some more examples. So like I said, there are key strategies here that are very replicable. The first being that mean reversion trade that we talked about. So when it wicks up past the point of control, past the value area high, and starts to find weakness, we trade it right on back down to the point of control, and we leave a runner for the value area at the low. Because price in a consolidation pattern in a D profile, what you're going to see is essentially mean reversion. I mean, we can just keep it nice and simple. Just mean reversion. So if it's at a premium and we know it probably wants to go back down, easy fade, and then it'll often kind of just navigate the range really efficiently and go down to that value area low. So if anybody watched my Fibonacci's webinar, or if anybody trades with me in my Discord server, you know I love Fibonacci levels, and I love using them to analyze ranges. What you'll notice is that in a range, the Fibonacci's that tend to get hit often roughly align with the value area lows and highs. And what that kind of is telling us is, so remember, 50% right in the halfway of the range, that's the equilibrium. If it's under there, it is at a discount. If it's above there, it's trading at a premium. The 0.62 fib is under the 50, but it's not like egregiously low. It's basically an area where you'll often get a dip to in a range before it comes back up and starts trading at a premium again. Very often that will align very neatly with our value area low. So there's just kind of a uniformity to these systems. There's a confluence there, and I always love confluential signals there. You know, that's what I'm all about, stacking things, signals in our favor. So it's just one more way to look at this. Just wanted to throw that out to you guys. Let's see, RB. So this volume profile will give us better insight into the movement of money. Absolutely, that's a really good way to frame it. Basically, it is taking all of the chaos of up candle, down candle, up candle, down candle, and it's giving us one shape to define that cohort of price action, that cohort of traders that comprised of that price action. Because remember, a chart, all it is it's a visualization of the group psychology of everybody trading. You have the exuberance, shown in the big expansion green candles. You have the fear shown when it sells off abruptly. And most importantly, you have a good sense of where it's going if everybody wants to buy it at a premium and keeps pushing it up, and it finds price acceptance there and keeps going higher. So yeah, absolutely. This will give us a really good insight on where money is moving. If this example here, if we saw most of the shares trading down here and the profile looked more like this, then we'd be really worried. Why are people trading so many shares down here? Like, that's spooky. If it's accepting down here, it probably wants to go lower. But the fact that it didn't really accept down there, it shot back up both times, that's a sign that we want to go up. I'm just noticing you couldn't see my drawing that I just did there. Let me redo that where you can see it. So, sorry, still learning this tool. So if the volume was mostly traded down here, I was saying that would be a cause for concern, because we would probably want to trade down. The fact that most of it's trading up here and is finding acceptance up here, they're like, yeah, this is fair. If it's fair, they're going to try to offer the bid higher and higher and higher. And that's what we saw. All right, now we can move on here. So let's talk about these profile shapes and how they affect market psychology. And I keep getting ahead of myself, so I'm sorry if I'm repeating myself, but this stuff, I just love it. It makes a lot of sense to me, and I'm excited to share it. So this normal distribution that we're talking about, the bell curve, that's going to look something like this right here. So just remember D shape, nice and simple. Nice and simple. So when you get a shape like this, you're going to expect this point of control to be retested before we decide what we do. So during price action today, you could short above the value area high there and get a nice trade back to the point of control, and it would even continue and barely tag the value area low. So then you could also say, hey, it's at the value area low and it's finding buyers. You could have taken this trade and swung it. So what I really wanted to show with this example is that when you have this price acceptance pinned to this range, what we want to do is see, first off, which direction is price moving away from it. If it's gravitating away from a place of acceptance, that's an indicator that we're going to find new acceptance higher. But often what you'll see is, okay, it's showing the impulse that it wants to leave this. It wants to move on out. It wants bigger and better things up here. But first it needs to double check and make sure that everything's squared away back here. So what does it do? It comes back and back tests it first thing in the morning. And this is the area that we're looking. This is the area that we're looking because we already know that where it is from yesterday. That's what I'm saying. People who just open their charts every morning and don't look at the context of what price did yesterday, they are trading at such a massive disadvantage. They're sitting here bullish and right at open, and they get knifed to support, and they go, "Oh my God, I was wrong," and they sell, and I buy their shares, and I'm happy, and they're sad. Obviously, not always. I get whiplashed a lot. I got whiplashed hard on Intel, and somebody bought my shares and made a lot of money. But that being said, more often than not, we can use this to inform really clean trades. So this was a really clean trade where we knew that price wanted to go up. We were going to wait for it to backtest and confirm, and then boom, expansion. So that's that balanced range there. And let me catch up on some questions here. Whoops, I left you up on screen there, RB. Mike, good to see you, brother. Good to see you in here. All right. Extraordinary Cave Trader says, yeah, when it sells in the Bollinger to sell. Sorry, I have a learning disability. I have dyslexia. Let me read this in my head first. Okay, yeah. So basically, Cave Trader here is talking about a similar concept with Bollinger Bands. I think you might have heard this from Big Money Mitch talking about the Bollinger Band squat, and that's such a good look. That's such a nice trade, and it's very similar to what we're talking about. So it's going to test the buyers and stretch them, and then shoot out of there, and that's kind of what we're seeing on these moves down here. So good connection of ideas there, and this is the thing about TA that's so beautiful. I don't care what kind of system you use, we will find alignment in our signals almost always. And it's even more beautiful than that because it's not even just all of the different schools of TA will find alignment. I have a lot of friends who just do fundamental analysis. They think I am a schizophrenic person staring at lines on a screen that mean nothing. That's fine. The crazy thing is that we often arrive at the same valuations, the same fair value, because the TA does work. And the TA is reflecting fundamental properties. So just a little bit I think that's really interesting. A little market philosophy for you or something. But going on here, what do we got? RB, I apologize. I have another monitor there that wasn't showing my things for a second there. You can see my cursor here now, correct? A little yes or one in the chat would be great, just so I know I'm not crazy. I'll draw something on the screen too for you. Okay, you can't see that. You can see it if I do it here. Okay. I apologize. I'm still learning this drawing tool and which screens it'll appear on. So going forward, I'll make sure to do it there. Sorry about that, RB. If you have any questions about what I was drawing to myself, apparently, please let me know, and I'd be more than happy to elucidate there. Going on here. Scott 2, welcome. Nice to see new faces in here. Do you use volume profile on after hours plus trading day or just trading day? Great question. So basically, for futures, I think it's very important because there's a lot of shares that trade overnight. It's really important context to have. For this is kind of my basic rule for all after hours, like incorporating after hours price action into my TA. If there's significant volume, then yes, you need it because you need to know what that significant volume is doing. If it's a small cap, well, maybe not small cap because they can get big volume after hours. If it's a let's call it a stock that just trades very lightly, very lightly after hours, those ones that just don't have that big interest for whatever reason, a lot of boring stocks, we'll call them. I don't really care about, anything that goes on in there. What's going to matter most is, like, say it gaps up overnight. It's probably going to still want to come back and revisit the high volume node from the previous day, just because that's where the actual transactions can occur. That's where people who want to get back involved long, who sold it the previous day, they can say, well, I can stomach getting back in here. This is basically where I sold. It's a pivot area, essentially. It's an area where if you got caught short, you can ride it back down there and relatively confidently know that, okay, there's a reason why they'd want to bring it back down to this area of interest, that kind of thing. So I do use it, especially for futures trading. I do a little bit of futures trading, but yeah, it's not super essential for low volume after hour stocks. All right. From Joseph, let's see. We got, how would the point of control play against the VWAP? Interesting question. So often you will find that the VWAP and the point of control are going to be basically the same, because the VWAP, that tells you they're both volume weighted, right? So they're both operating on the principle of they're affected by volume. And I guess I'm not sure 100% what specifically you're asking, but I use both and they work very well together because they both tell me what I want to know, which is how many traders that are trading today are underwater, how many are green, how many are, where is the volume occurring, what is the sentiment like? If the sentiment, if we're trading above VWAP all day, everybody's thrilled. The average person is green, they're happy. Why would you sell? Keep it going, run it hot. This is very, very important for like small cap traders. If you start trading under VWAP, you can start to see a waterfall as short-term traders say, hey, I don't know what's going on, but I'm red and I'm getting out. So they're both incredibly important. You should have both on your screens. Let me know if you have any more specific questions on that, Joseph. All right. Q Trader, getting advanced here, saying IMO, if you combine the VAC and the VAL, is the VAC the value area center? But either way, if you combine those levels with the Camarilla pivots, you have some nice reversal zones. Absolutely. So Camarilla pivots, another thing that I use very regularly. That's what my intraday, one of my intraday, what do you call it? Indicators that I use is all about. And yeah, Camarilla pivots are great. If you want to learn more about that, guys, got a webinar on that too. So awesome. I love this connection of different concepts because it really helps. It helps make those synapses connect in your brain and have the stuff become really intuitive. So if you can take this system you're learning and connect it to something you're familiar with, it's like, boom, you're in there already. So RB saying, okay, or when you get stopped out and then it bounces back high, have to wait for reentry again. Happens too much. Absolutely. Because when it starts to break a range, you're like, oh man, I know this is bullish. I just want to get involved. But, if everybody knows it's bullish, there's going to be some people who expect to fade that back and make sure it's real. If it's real, then they'll back test it and it'll hold. And then you get the high probability trade there. So yeah, absolutely. Just waiting for confirmation. Always the way to go there. All right, let's get on into some skewed distributions. So before, this was a normal distribution. And by that, it's relatively balanced. So if I go over here, now you can see my cursor. So relatively balanced here. Most of the shares are trading right in the middle. But going on, now we're going to get into some skewed distributions here. So this is skewed, obviously, to the positive. So that means that there is strength above value. So above the value areas, above the point of controls, it is saying we are not getting discounts in the range very much, and we're still buying this up. Any little discount, we're all over it and we're pushing this thing up because on a higher time frame, We know where we're going and it's up. So usually this is because there is a large floor that was found, a large buyer absorbing sellers, and then that starts to, digest, and eventually the buyers outpace the sellers and push it up. And then both institutional investors who are buying and also market makers who are looking to to be on the other side of this trade in the most efficient way as possible, they both have an incentive to push price up to the next very high volume node above. And that can be very significantly, much significantly higher. And if it is, you can get these big expansions up like this. So with these expansions, what are we looking for? We are looking for these P-shaped profiles. So first off, remember we have the D shape. This is where we were still deciding what we were doing. And what do? We try to push below the range there. And we say, no, no, no. Price did not accept down there. Price rejected down there. That's cool. It's called a failed auction. They tried to auction it lower, failed, snapped back up. Where does it snap back up to? Let me draw this for you guys. So here's the balance. Let me change the color, make it a little clearer. Yeah, nice magenta. Okay. So here's the balance in this range. And then what we're going to see is that here's the price where it closed. And then here's the failed auction. So it ran stops right to about there. It couldn't push below and start selling below that. So because of that, it failed the auction. We're going to go back to the point of control already established. And this is one of my favorite setups, the failed breakdown. Telling you, these guys are so money. This is just cash money setup. We lose a level. We come back, we reclaim it, and then we just ride it. We just ride it until it loses something major. So get the major gap up. Beautiful, beautiful, beautiful. If you're a day trader, you get a big impulse move into the bell. You always sell that. Almost always. I always sell it. Because if we're going to see continuation, it'll give you more chances. It'll give you more chances almost always, unless it's a crazy mechanical, insane move. But so we sell there, and then we watch what it does. Runs up a little overnight, tries to push below, fails. And we see the expansion. It wants to push higher. It wants to push much higher there. So that's very bullish. But price is still going to want to kind of just always back test. So this one is a pretty steep undercut. But again, we don't worry about the overextensions to the upside or the downside because that is not in our value area. See, it's not even showing on our volume profile down here. I got to really lean in to see, but I think the value area low is somewhere around there. So essentially, what that's telling us is we don't care if it is, we just don't get involved here until we get confirmation of the trend again, which is another failed breakdown. You're right back in here. And lo and behold, it's right off the opening price there. So like I said, when price is working, when price action is working and buyers are buying, price will keep getting offered up higher until there's a reason to sell, like de-risking at the end of the day or whatever else. And then price will very, very often, almost always, come back and reconfirm that it's still bullish at the key levels. So let's continue on with this example because I think it's just a really good one. So again, failed breakdown, we're in for the overnight swing. Runs up overnight, and then right at open, what does it do? It does the same thing. It comes back and back tests our key level, key pivot, and what does it do? Fails the auction. Fails the auction right back on up. You see, it's like clockwork, guys. And this is super important because if you systematize your trading, you will know when something isn't working. And then you're not going, why isn't this working? You're going, hey, this isn't working. That's telling me something. That's telling me that the market isn't in this impulse ready to go up move. So this is super important where you can take a losing trade, you can take a stop out, and you can have that information. You can basically, instead of looking at it as just a loss, you can look at that as you paid for information. You got valuable insight on the market based on this stuff. So moving on. What do? We back tested here, failed auction, big impulse move up. And what do we see in the volume profile? Where is volume hanging out? Look at that tight P. That's beautiful. When you see one that defined, you know you're partying. So how do we play this? If we see a big one here, if you see this stick and you're scared to get involved anywhere here, but then you see it closing up here and you're like, damn, that looks bullish. I wish I was in this. How do you get involved? Because it is bullish. Let's talk about it. So we have the top of this volume profile here. That's going to be key, right? our value area low. Let me redraw that a little more accurately. There it is, our value area low. So notably, it didn't even get to the value area low when it came back and retested. But what we want to look for is our point of control. We want to watch what price does when it dips below and above this pivot. So ideally, it wants to act like a beach ball underwater whenever it's under this level. And why would it do that? Because a beach ball underwater, it has a strong gravitational, incentive to not stay underwater, right? A bullish stock has a strong gravitational incentive to not stay at a discount. Because if something's good, it's not going to stay on sale for long. That's just basic supply and demand, right? So knowing that, here's our pivot. We want to get involved. So if we see price dip below and start to fail an auction and maybe reclaim a moving average or something like that we see is playing nicely. So if we look back, we can see this yellow, the 21 EMA, and this is on a what? It's on an hourly chart. So the 21 hourly EMA, it's been playing real nicely. So that's a level we could look to define risk and look to play a failed breakdown. And so that's what we get here. The failed breakdown through that level. Often it would want to come back to the value area, but if it's really strong, it doesn't have to. If it's going up and it's not going to be offered at a discount, that tells us something too. So that's where these failed breakdowns under the point of control, but showing strength under the point of control, can give you really nice entries. And you can always play it safe and take profit when it's above the value area. And if so, then it gives you the opportunity, the latitude to trade around a core position. So if we are, if we're trading this, like I said, we're stair stepping on up. We're taking profits, we're getting back in. We're taking profits, we're getting back in. We are building a cushion. And when we get in on here, it doesn't always work. It could fail. And if it does, we stop out right under there. No harm, no foul. Part of the game. But if not, we get up to the value area high. We sell a little bit. Comes back and we look for the exact same setup. Failed breakdown under or through the point of control. And yeah, price goes on up, on up, on up. And this is so constructive. See, just another P. When you get another P, cash money. And what does it do? Comes back and it back tests the previous swing high. Mechanical, guys, mechanical. Just stair stepping. So there we go. That's a really good example, I think. And then again, you got your key moving averages. You got your back test of here. Failed auction lower over the previous high, telling us that price is not going to go in this high. It wants to go up. If it talks, we listen. Boom, big surge up. So this is a really good example of these skewed distributions and how you can sink your teeth into a good trade that you catch early and then just keep on riding it like that. Let me delete all of these drawings. I feel like John Madden or something, drawing X's and O's. And all right, let's get on into it here. So we talked about balanced profiles, the D shapes, where we want to revert to the mean. And we talked about skewed distributions, and we used an example of a positive skewed distribution. Let's talk about the last of the major kind of replicable patterns that you'll see on these. Sorry, Nick, you're distracting me there. All right, so bimodal profiles, and then we can talk shoes. Bimodal profiles are where there are two distinct value areas. And what we're going to be focusing on for this example is price action right up here. And why can I not? What did I just do? Okay, let me get myself sorted out here. There we go. Okay, we're on the right tab. Let me get back to my crayons. There we go. Okay. This is what we are going to be looking at right up here. So this is a bimodal volume profile. See, really clear. Two nodes. One here, one here. So let's talk about what this means. This is a setup where you often will get gap fill opportunities. And why that is because it's essentially playing ping pong up here. So it surged really high but then it finally found a failed auction higher. For the first time, because this is immediately after the last example. Sorry, I forgot to mention that. This is the end of that big move. For the first time, see this previous high? It failed an auction higher there. Right out of the open, it failed an auction higher. And this is why I think volume is so much more important than just patterns. Because we were just in like 7 days in a row of up, 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 right? This is the first day that volume is telling us something up here. But if you're a pattern trader, you're like, man, that's a big stick and that's a flat base. That's a flag. That's bullish. Let's see. All right. Tony, failed auction determined via strong sell volume. Yes, correct. So a failed auction is when price revisits a key level that was, very important, usually on the previous day or on a previous week, something like that. Any notable price level that gets revisited and is sharply rejected, where there are sellers, it's an imbalance of sellers coming down to it, and then they find a large demand zone where the sellers get rapidly outpaced, buyers step in ferociously and say, no, 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 we're not doing this. We're not doing this. You thought, I know, but no. So it's that kind of thing. Just that's when bears fumble, and you love to see it because as the bears fumble, they have to start closing their shorts out. They have to buy back their shorts. That's fuel for the fire, right? So you get organic buying, organic absorption of these sellers. Then the sellers start panicking because they're punching this wall as hard as they can and it's not budging. They start bailing. It starts going higher as they bail. They start bailing more. They start getting squeezed. Buyers see that, they add fuel to the fire. And this is where you can get these big reversals. That's what's referred to as a failed auction. Good question. All right, Tony, yes, we can do more examples. I got these tied to the slideshow here. It's a bit of a logistical thing, switching back and forth to charts. So I will do charts as soon as I'm done with the little presentation. We got a little bit more, and then we can get into whatever you want to talk about. More than happy to. So awesome. Oh man, over 100 viewers. Thank you guys so much. Appreciate it. If you're here from Trader TV, thank you so much. I appreciate that. If you want to follow what I do, you can find me on my Twitter at Steve Teilman, SteveTeilmann. And I try to post there as much as possible. I'm always in my Discord community too. It's free to join. You can find that in the Twitter link too. So going on from there. Sorry guys, I have to do the plug. I hate it, but all right. Oh, did we talk about this enough yet? Let's talk a little bit more about how to trade these. So essentially what you're seeing when you have a failure of this high volume here, a failed auction, you're kind of on your toes. You can't be a bull. Doesn't mean immediately go bear. For me, I would be looking for extension long because we kept going up day after day after day. And when we failed this auction, I would say, okay, this trade is over until I find where the buyers are. Doesn't mean I have to short. You could, if you were waiting for a failed auction, maybe you were sitting there waiting and got this. Beautiful. Same concept. But, I like to just look long and mostly trade long. So now what do we see? This is like building a house on sand. We popped up and buyers or sellers said, no, get back down there, right back to the neck, right back to the neckline, right back where it starts building significant volume. And this is, switch my screen again. All right, this is notable. Let's talk about this. So this is where, again, candlestick patterns can be much more deceptive than the volume patterns underneath. We should always watch the volume. What I mean by this is, if you were a raging bull this whole way up, and okay, you finally failed an auction, whatever, you're still looking to buy the dip, right? Comes back to support where it broke out from previously. And what do you see? You see some nice bottom wicks on the hourly there. In a vacuum, those candles are bullish. What does it lead to? It does lead to a little bit of mean reversion up. But what is it actually doing when it moves up after putting this shaped volume profile? Think about it while I drink water, and then I'll answer you. So, I'll give you a hint. See this empty space here? That is a bubble on the tape. That is an imbalance. When price slashed through there, it was an area of low acceptance. Remember that? Low acceptance. What that means? Went straight through. What it also meant is not many trades or shares were traded there. And from a market making perspective, that's a very appealing place to try to bump the stock up to. Price always wants to move to the path of least resistance. It's just like water flowing downhill. It is, just kind of as simple as that. So this is so repeatable, so common where we'll see this. We come down, we trade the meat of our shares down here and up at the very top. So we have two areas of interest, and one of them just rejected, and the other one we're just sitting at. So what do? We come back overnight and we fill out this loose area, this area where it's a paint bubble. If we were taking a paint roller and sweeping a wall up and down, painting it, and we got too excited and just really slammed that thing, and it went way too fast, paint shot everywhere, and most importantly, there was a big bubble on the wall because it didn't have solid contact. It didn't have a balanced auction, if we were talking about it in stock terms. So what do? You roll the paint roller right back down. So we rolled the paint roller too fast down this way, and we left a little bubble. So we come back in, we iron that out. It's called cleaning up the tape, cleaning it up. Nice and neat. This is all about path of least resistance, logical price action from point A to point B to point A to point B. This is what we do as a technical analyst. We figure out these likely moves, and we make our money just catching these small moves, level to level. And if it keeps working, we keep with it. If it doesn't work, we cut it. So that is a bimodal profile there, and that's how you trade them. So if you reject a big node and you form another one, you have a range, and you want to probably look for price to come up in here. You can take this long, but it's not the real exciting trade, and these feel bad. You guys know these trades. We've all been in them, where price is grinding up, and it is going up. But if you're in options, there's no real gamma thrust. It's just kind of grinding up, riding. It's holding moving averages. There's algorithmic buying. Every time it comes back into the 9-minute EMA, people are buying it, but doesn't feel explosive. And then all of a sudden, whether it's a news, a data release, whether it's an hourly flip, whenever there's some change in the market participants, whenever new algorithms turn on, whether old algorithms turn off, whatever it may be, you will just see the bottom fall out. And these feel so bad because you're like a frog boiling in a pot of water as you're long up here. And you're like, well, it still is going up. I shouldn't get out. It's going up. But you don't have the context of why it's going up and where it's likely to head after that. So for me, this part here isn't a very good trade. I don't really care about that. What I care about is finding sellers in this paint bubble here. And once I find sellers, you see those top wicks there? There's my defined risk. And you can play a breakdown of a significant level. You can often do the pre-market lows. You could be a little more aggressive here and do that opening little range low because it was trading so tight. Totally up to you and your trading style and your risk tolerance and all of that. But these are the really nice explosive moves. And you know these are the moves you want because when you're on the other side of them, they feel terrible. And those are the trades you really want to be in on the right side. So again, what do we see after all of this? We just described the concept. I'm going to undraw this. But then we have another one forming here. B for you better not get caught long. So what does it do overnight? Very replicable patterns. And another thing, the hourly 21. There's another way to define risk. See that? Comes on down. Just Dikembe and I'm right up there saying, no, you are not going higher. So more areas to define risk, more areas to trade nice and technical and cleanly, and you can keep your emotions out of it. And also the other thing here is you're looking at hourly charts. I mean, not always. I trade 1-minute charts like a insane person too. But when you're framing your trades on hourly charts like this, it is so much less stressful. Like just physiologically, you freak out less when there's a red candle because you're like, oh, this would look terrible. This would look terrible if I was staring at a 1-minute chart and I was only looking at price action here or whatever, and not looking at all of this stuff. But with the context, it all makes sense, right? And here's the other thing. If it doesn't make sense, that tells us something, because you guys are good students. You're going to do your homework. You're going to look for the stuff and you're going to internalize it. If the patterns don't play out, that's information. Patterns break. Everything breaks. Everything works until it doesn't for trading, So that is kind of, I kind of got into my philosophy, my ethos as a trader there, a little more than just this example, but I think it's really important. So let me catch up on the chat here. Gurkhan, this is an interesting question. It is off topic though, but I'm doing a webinar on options trading next week, and I'd love to touch on this as a concept really briefly. So you're asking if we can take options open interest into account as resistance and support confirmation. It's very relevant. There are a lot of intricacies to this, and I won't claim to be a super big expert, but I do know a decent bit about flow and how to read it. And I think this is going to be really good for next week. So I'd love it if you come by next week and we can get into that then. Thank you for the question, though. Nomi, that means so much. I really appreciate that. If you or anybody else is interested, I do offer a one-on-one coaching too, for quite reasonable price. I think you can come talk to me on Twitter, on Discord, and we can talk about that. And also, just come hang out in my Discord. It's all free. Great traders there. We have fun. So hope to see some of you guys in there. Okay, Scatu. I don't know how to say your name, but I like it. All right. If the close is below 50%, but the volume profile shows a P, what do you make of it? Good question. So closes are important, especially because they're very high profile or high volume areas of interest. The P is good. The B is bad. Yes, RP, exactly. Okay, so P is good. We have a P, but the close is below the 50%. What do we make of that? Well, there's a few things we can consider it. We always got to consider it as a part of the bigger context. How I would look at this, and this is just off the top of my head, kind of throwing different things at me. I'll do the best I can. What I would frame that as is, it could be some kind of trappiness on the tape. It could be you can construct a chart, if you're a market maker, so to speak, to trap people in a position that is beneficial to you. Crypto likes to do this a lot by closing market hours, like the cash session of the trading day, with a really bearish daily candle, but then right after hours, you see people just buy it up, and then it's a gap up, and then, that kind of thing. So they kind of trap shorts like there. It could be that if in the context on a bigger level, it's a bullish, constructive, stair-stepping migration of P-shaped patterns. Then if it closes under, that might be a buying opportunity, and it would gravitate back up over, and you'd be in your trade already for the breakout. It is not like a super clean cut setup though, like some of these. So I would recommend, if you see this, to observe and see. And guys, this is okay. So this is for the serious traders out there. You guys are all serious enough to be here instead of, being out drinking on your weekend already. So I salute you already. But if you want to get really serious, this is how you can take it to the next level. Every time you see a setup and you're like, I don't know what's going to happen. I wonder what's going to happen. And then you watch and it plays out. Take pictures. Make a folder in your computer. Make different folders for different kinds of setups. You will be compiling lookbooks of what you should look for these different setups. You can go through these and you will just start to absorb and internalize what each setup looks like, what the characteristics are. And that's how people are like, they think it's a superpower because I'm not trying to brag, because it's not a bragging thing. This stuff, anybody can learn it. It's just thousands of hours in front of the screen. But you show me a chart, I'll have an opinion really quickly. I flip through 500 charts a day. It takes me 5 seconds each. I don't see everything, of course, but you get a very intuitive feel for what a chart is doing. And if it's checking the boxes, then really quickly. And this is how you build that muscle memory, by compiling evidence. And I know it's not glamorous. It's hard work, but there are some tools we can make it easier. Actually, I want to do a webinar, because what I do is you can actually install an LLM into your computer, and then I don't even have to label my things. I'm just like, hey, organize them by these different kind of patterns or shapes or names or whatever, and it can kind of do some of the heavy lifting for you. We can talk about that later if you guys are interested. But yeah, just in general, Interesting. I like these curveballs, Scott. I'm gonna call you Scott. I don't know if that's your name. I like these curveballs though. It helps me formulate how I'm thinking too. Um, so. What else we got? Nomi saying like a baseball hitter, flashing pictures of pitcher hand. I like that. Yeah, exactly. Yeah. So you're just internalizing this stuff, and so this is how I like. It was taught to me this way, and it really made sense. This analogy. So what we want to do when we're honing our trading system and our technical analysis and all of this is we want to basically get as much of this into our RAM, if we're a computer, into our RAM, like our easy access memory where it's already loaded. We don't have to generate anything. It's just bam, right there, ready to go. So we do this by doing the homework, internalizing this, by knowing our setups before. So we're not opening the charts and immediately hitting buy or sell and finding ourselves underwater and freaking out and snowballing. And now I'm describing what I did today. No, I'm kidding, but I did take some bad trades. But in general, the more preparation we do, the more muscle memory this is. When you see a really good trader, they make it look so damn easy. And when I'm trading well, it's so damn easy. When I'm not trading well, it's because I'm not following my rules and stuff. So um, we're just building a skill set here. We're honing a skill. All right, all right. Yeah, Joe, absolutely. I mean, mindset is probably uh, pure RTA is probably my biggest strength, just because it's all I do. But mindset, I do think I have a lot to say about this because hey man, we all experience our trials and tribulations. I've definitely paid my market tuition. One thing I will say is never trust anybody who's told you they've never taken big drawdowns. They've never cataclysmically messed up a trade. They've never, most of them probably blown up an account or two. I've blown up an account or two. This is part of the process. You don't have to mess yourself up too bad, but you are going to make mistakes. Don't trust anybody who says that they just knew this stuff from the start. So that being said, be kind to yourself, guys. You're doing a really hard thing, and you're diligent. You're here learning after hours. So yeah, I commend all of you. Absolutely. RB saying, everyone I speak to says discipline is key. If you can't commit to your trading plan and rules, do not trade. Let a broker do it for you. DCA into SPY, 100%. I'll go one further. A plus trader trading really good system, but they just have no risk management. They will blow up 9 out of 10 times eventually. A mediocre, just getting started, barely knows support and resistance, barely knows what a moving average is. You say Bollinger Bands, they look at you like you got three heads. If they have good risk management, they will outtrade anybody who does not over a long enough period of time. It's that simple. You don't even have to be good at it. You just have to be good at the discipline. I know people who do not know anything about TA. They trade very well just because they have incredibly regimented risk management, and they will only take a trade if the risk reward is there. And even if they're wrong over half the time, when they're right, it makes up for it because they practice the risk management. So if this is speaking to you and you need more of this, I have a webinar on that too. At this point, I have a webinar on most things. And yeah, if you ever want more in-depth, help with that, I do have good experience working with people through their individual mental hangups, because we all got them. So anyways, moving on, let's power through the rest of this and get to some examples or anything you guys want to talk about. Because I'm over here yapping. This is like therapy session or something. I'm just talking and talking. Let's talk about some setups. So high probability setups here. Let's get into it. Let me delete my old drawings here too. How the heck do I delete these things? There's an eraser. There we go. Oh, it's going to drive me crazy. There it is. Okay. We're cooking, guys. Ledge patterns. What's a ledge pattern? A ledge is an area of significant volume. Pretty easy, pretty straightforward here. They represent institutional inventory positions. They represent where big money is getting involved in a trade, either buying or selling. So I should say either accumulating or distributing. because big money, they get involved, and then the trade happens and they unwind, they unwind the trade, they take profit as it goes, yada yada yada. But the big volume is where they're either accumulating or distributing, in a range where they will be accumulating to push up from, or where they are distributing their inventory because they anticipate and or will make the price go down with their selling. So that is what a ledge is. That's what institutional inventory will look like on a chart. And we have some examples drawn out for you here. And these are defined by, you can see right on the volume profiles, they're very abrupt. The value area highs and lows are very abrupt there. See what I'm talking about there? Hard level, hard level. The technical definition of a ledge, on like a TPO, for example, is when one row to the next, one time period to the next, price level to the next is has two or more, a discrepancy of two or more from one to the other. So it's like a sharp move down, right? It's not a gradual D shape like that balance profile that we were talking about earlier. What these tell us is that these are areas that we have to watch very closely. They are high probability points for reversals, and they are just areas of institutional interest. So we can play this in different ways, but in general, it's going to be an area where you're going to look for these failed auctions and for these pivots to form. So let me get my crayons here, and we'll talk about what we got going on in this example. So the first example here is this ledge right here, which forms this nice flag. So in this nice flag, we have a pretty low value area low, value area high there. So we kind of are forming this ascending triangle into it. We are not spending much time below the point of control. This is all very bullish, all very bullish. So what you can look for is to play a loss and a reclaim of the point of control. That will be a little bit safer in terms of you can trim if it goes above in the value area high. And if it back tests, that's going to be an area where you can add a little more. You can also look for the value area low to be swept and reclaimed. This one did not get that. So for these really strong flags, sometimes you just have to pick your spot. I mean, you have to trust the analysis that you did and hope it works. And if it doesn't, you take the stop. But in this situation here, what we're seeing is there's this big shelf, and we're just watching what price does in the shelf. So it tries to push up, nope, still pinned. Tries to push down, nope, still pinned. Tries to push up, nope, still pinned. But what is it showing us in these peaks and valleys? The lows are not digging into meaningful demand zone. They're not getting very far. They're getting bought up pretty quickly. The highs, they keep wanting to push higher. They keep knocking out stops here, knocking out those shorts, making them buy back a little bit. Okay, they, more shorts enter, but then they're closing out right at equilibrium, right at the point of control. So these guys are trading our system here. They're fading the value area high, and they're taking it right back to point of control. And there's absorption here. That's an institutional absorption here of sellers. And eventually the shares transfer from these weak scalping seller hands to these big, Chadley strong institutional hands who want to send this thing. So we see pre-market, it shows again an incentive to sweep this value area high. When a level keeps getting attacked, that's a sign. When it keeps getting attacked and it doesn't reject hard, and each time it rejects less and less, we are seeing buyers winning the war of attrition. They are just knocking on sellers' doors, and they are not going to leave. They might push them off a little bit, but they're right back there, It's faster each time. So eventually that pressure will resolve itself. When it resolves itself, we watch what it does. So it unpins. Where's my cursor? Trying to get it on my other screen here. There it is. Okay. So when it unpins from the shelf down here, we will get more opportunities. See, it back tests our value area low, and there's a failed auction there. So you could play the reclaim of whatever your level is here, whether it's the top of this shelf, that's valid. Whether it's point of control, that's usually what I do. Whether it's that key moving average, all valid, but they all are telling us the same thing, that we are defining our risk below here because it already tried to go down. And if it goes down again, we don't know what it's going to do. What it should be doing is playing nice, scoop out once, can't make a lower low, time to path of least resistance on the way up. So there you go. There's that big expansion up. And then what we're going to be starting to see up here is balanced profile, a D shape. So we got the big expansion move, tries to flush out. Oh, I'm sorry, I missed this one right here. I think this is why I actually made this example. So price got extended. Crazy move up, right? Because institutions were buying it and people plowed in. But then what happened? Institutions, they got a nice discount on their inventory. Now in pre-market, in low volume, they have a great chance to sell. They bought a bunch. It's higher on low volume. Now they're going to pound it. They're going to dump all of that inventory. They're going to say, oh, yeah, you wanted this last night. Let's see how much you want it in 10 minutes here when we sell it on you. So they sell it on you. They just drop it on your head. But this is all in the context of they accumulated a big position down here. And then on this day, see, they accumulated more on this day. There's another volume shelf here. So stair stepping up. It's bullish overall, but these guys are traders. It's not even guys. Don't even think about it as guys. This is mechanical. This is algorithmic. This is systemic. It was bought cheap. They need to sell it. They will be buying more. They need to constantly be buying and selling, managing positions. This is what it looks like. So inventory up high. They dump it on you in the morning. Very, very common thing to occur when you have the gap up. And what do? We watch and see where it's reaccumulated. So it doesn't do much this day. It just kind of hangs out right around pin to point of control. Not bearish, not bullish. We don't know what it's doing yet. Overnight, it drifts down. Overnight, we are basically saying, this is the paint roller. We got too aggressive. There's some holes here. What do? Like a good painter, we sweep it on back down. We make sure we do a good job. Market. These guys are professionals. This ain't the Bush Leagues. What do? They come back right to the last point of interest, this point of control, and our ledge, the top of our ledge. It can go down to the bottom of the ledge. It can undercut it. We don't buy it the second it comes down here. That's scary as heck. What we do is we wait for the failed auction. Big move down. Immediately we see high volume. Big old high volume. That shows it just tapped into a big order. That's the institution buying. Why are they buying here? They just bought here. Why are they buying here again? Answered your own question. They sold up here. They're buying it back. What a trade. And they send it up here even higher. They sell it on you. Where do they buy it back? Into the previous area of interest. I didn't draw this one, but there's a ledge here too, formed by both of these days' points of controls. So this is where you have the stacked points of control, creating an area of institutional interest. And this is an area where you can define your risk against and where you can look to enter long again. So big liquidation, big move back here. You're a baller if you caught this because you were paying attention. If you didn't, when it comes back up here and reclaims point of control, that's another buy signal. Sometimes you don't get the super good deal, but you still get a good deal because it's going higher and you know it now. So it's okay to pay for confirmation. That's totally fine. What you don't want to do, say, oh my God, we're bullish, and buy in pre-market because you know it's going higher. I don't care if it's definitely going higher. Don't be a dummy. Play the path of least resistance. Don't get caught like this. Just wait for it to come back. It might not always do it this cleanly, but you'll find a spot. RB, yeah, let's talk about this real quick. Taking profits, dropping the price as a result. You could almost call it market manipulation. All right, guys, let's talk. Let's talk, guys. Markets are manipulation. Don't look at it like, oh, they're doing crime. It's just good business. It's just, I look at this all as like a natural unfolding of things. You can't blame a scorpion for stinging. You can't blame somebody whose job it is to efficiently offload inventory at a premium and buy it back at a discount. You can't get mad at them. They're the ones who hold the majority of the shares, market makers and large institutions. The majority of shares do not enter or leave a market on any given day. A very small percent of money is actually entering or leaving. It's all getting moved around. It's like the Always Sunny meme. It's like the money's going in a circle, It's always going in a circle. So the more we can frame this from the lens of a market maker who needs to do this constant buying and selling, they need to be the other end of the trade, right? So they need to constantly be efficiently navigating ranges, because if a stock is ripping and they have a legal obligation to sell you something that's going up, they have to do these kinds of things. It's not crime. It's not, this is good for us because it means that the system is replicable. It means that this is a ATM. You can extract money consistently and reliably from the market if you know what to look for. That's what they're doing, and we're following them. So I just want to talk about this because it's so easy for retail to get caught in this victim mindset where it's like, oh, the hedgies are out to get us. So, think like the hedgie. The hedgie is smart. The hedgie is doing what you're doing way better, so we want to be like them. Look at it like just good business of buying low and selling high, and navigating bigger price moves through those peaks and valleys so you can maximize your gain on that move. So, yeah. What else we got here? Extraordinary Cave Trader saying everyone is working all day in the trading market. Just work with it and it'll work for you. Yeah, absolutely. Absolutely. Scott saying, so these big algorithmic trading systems that can move markets, buy and sell daily instead of holding positions for month's end, or is this more like market makers? What I'm describing is how market makers operate primarily in terms of the constant unloading of inventory, but it's also how institutions will trade around a position. So in this example where we're going up, stair-stepping up, it's institutions who are buying that. It's institutions who are buying that, and then when it comes back down to their price, that's market makers kind of giving themselves some breathing room because they know the institutions are going to buy it again, but they need to sell it. They know the institutions aren't going to buy it at a premium, so they have a chance to sell it down into a discount. Then the institutions are going to buy it, and it's this constant like exchange of, it's like a dance kind of. I'm maybe not explaining it the best right now, but I hope that kind of understands the idea. So institutions, they are going to be operating on different time frames. So you have institutions, you have the scalping, the high frequency trade desk. You have the guys who are, trading on much longer time frames too, investing on long time frames. So these different cohorts of traders. They're going to act differently. And again, just like it's a dance between market makers and institutions, it's a dance between short-term traders and long-term traders. When a stock's breaking out, you're going to have the scalpers. They're going to get tired. When the move just comes down a little bit, they're going to take their profits. Those shares that they sell are going to be accumulated by an institution or somebody who's holding this for a long term. So there are different ways that you can conceptualize these different market participants. So for me, I use my trigger system. It's not mine. Somebody who is a good friend who now works as a quantitative analyst taught me this. So it's a good thing. It's a good thing that works. What it basically is it's going to give me different levels which represent different cohorts of buyers. So for example, if I'm scalping, I want to see my 1 minute and my 5 minute triggers hold, because those are the scalpers. Those represent the scalpers. When I lose those levels, it means the scalpers are probably going to get out, and we're going to have a little bit of pullback into the hourly trigger. The hourly trigger, that's going to be like for day trading or short swing trading. I will take a reclaim of the hourly trigger and I'll ride it up on the 1 and 5 minute trigger until the 1 and 5 minute triggers give out. Short-term algorithms, they're done with this thing for now. They're going to wait till it comes back to the longer-term support. And sometimes you'll get corrections. A correction will be when it loses the hourly trigger, cannot reclaim it. And then what does it do? It searches for the next trigger down. The next trigger down is going to be a daily trigger. That's going to represent where people who are buying on a daily chart, they don't care about what's happening intraday. They're waiting for it to come back to their long-term support level on a daily chart. And that will be their representative of them. So as long as they're buying off of that, that shows me that the overall trade is still in effect. You can keep on doing this for longer and longer time frames. The weekly trigger, very important. So that'll be more like quarterly rotational positioning. Like that's where, for example, I was buying BABA heavily last like November, December, January of 2024 into 2025 because they were accumulating off of this long-term weekly trigger. It was showing me that, hey, this is going up long-term. If it wasn't, there wouldn't be so many shares getting absorbed at this key deep discount level. So that is how I represent this with my system and how I think of this. Sorry if this doesn't actually answer your question. I'm just kind of rambling here, but I think it's very helpful for just kind of conceptualizing the market in a way that actually is aligned with how the movers and shakers of the market are viewing it. So then we're not getting caught off sides nearly as much. So, whole lot of talking. Thanks for sticking with me here, guys. Yeah, RB is saying stick to the big money like glue. Do as they do. Yes, sir. All right. No, me. All right, we're gonna get along. Me too. I my brain likes to make everything into like a. So the moral of the story is, or so this is like this, or I don't know. I'm either a natural teacher, or maybe a little bit crazy, but either way. So we got more. We got a little more for you guys. I know we've been going a while here, but you're still all here, so give the people what they want. So we talked about ledge patterns. Let's talk about poor structure. You guys recognize this example? Oh, let me delete all my old crayons here. Bear with me. Oh, sick. I can just drag and get them all. Perfect. All right, we're learning together, guys. Beautiful. So, what do we got for this example? It's the same example. Same example. Remember the house built on shaky ground here? So, this is a good example because we're going to take the last one and we're going to use it to explain a very common market pattern. And this is what I think is valuable about pattern trading. Pattern trading is inherently trappy because a low time frame flag could be just finding some more sellers a little bit higher on a higher time frame downtrend. So if you're only looking at a pattern in the context without the context, you can get trapped very easily. I will go one step further. There's a really good podcast. It's like called Interview with a Market Maker, and it's this guy. His name's JJ. He goes by like VWAP Trader. He's a really good follow on Twitter too. This guy used to make markets for small caps, and it's such a fascinating podcast because it's like a tell all, and he's telling it. He's like, man, we used to construct charts. Through market making a chart, you can influence the price action. We used to construct patterns that would trap people. We would set up a flag. It would be a false flag, and it would just break down, and they just take people's money. And this is, it is very predatory. It's very, it's kind of shady. But this is how the markets operate. We're here. This is what it is. It's better that we know, right? But when patterns can be valuable is when they align with this higher time frame analysis and this volume analysis. So we're going to talk about that. So what we see here, probably some of you already know what pattern this is going to be. Feel free to drop it in the chat if you know. But as you guys think about it, I want somebody to guess this. Come on, show me your listening here. What pattern am I showing here? I'll start to draw it. This is the neckline. Come on, guys, you can do this. Let me check on one administrative thing here. All right, let me try to fix my Discord audio. Sorry, Discord guys, if the audio is not clear there. I'm going to work on that right this very second. All right, somebody got it. 2 people got it. There we go, guys. You got it. You know what we're looking at. I'll be right back there. Okay. So Discord guys, if anybody is having trouble listening in there, we do have the stream on YouTube. It's only a few of you, so I am going to power through. I'm sorry if that's cutting out though, but come on to the YouTube side. The water's fine. All right, so head and shoulders, you guys got it. Let's talk about why this is important. Let me get my crayons. Let me find my mouse. Oh, goodness. These multiple monitors are messing with me. There we go. So we got the neckline here. Got a shoulder there. Got the head there, little shoulder here. So we talked about the bimodal volume profile there. Rejected here, started to build up here. So it's building up a node. Where is it building up? It's into this old area of institutional interest. We were assuming accumulation because it pushed up. At this point, it was accumulation. But this is distribution. Remember, we're constantly on any time frame in a cycle between accumulation, expansion, distribution, expansion. Accumulation, expansion, distribution, expansion. So in this case, we're kind of speed running it where we're accumulating, we expand, we're distributing, we expand. Are we accumulating here? Remember we said these candles are trappy. Our bias is not to assume we're accumulating here, because if this chart was reversed and price broke down, then found a lot of volume and surged back up, I would be licking my chops waiting for it to break through and back test to get involved, which is why I shorted right there. Does that make sense, guys? So because we have the way to frame this, we have the tools to frame where institutions were buying and when they started selling, we are ready for this setup, whereas other people might just be saying, well, it's back into support. Technically, it is back into support, but not all supports are created equal. So that is what I have to say about that one there. So this is poor structure. It lacks a balanced profile development. So that's what these bimodal profiles are. They are poor structures. And if it had a nice big belly like that, that would be proper structure or fair structure or balanced structure is the best way to put it. Why is it balanced like that? Because there is agreement between bulls and bears about a fair value. It like goes to, it finds that value in that B shape. This is showing polarity. Buyers and sellers are polarized. Who's going to win? Find out next week on Dragon Ball Z. Well, as we know, we already knew what we were looking for. We came back into support, so there's going to be buyers here. There's going to be buyers here. Doesn't mean they're going to hold, but there's going to be some bounce. Where would it bounce? If it's really bullish, it's going to surge higher than here and invalidate this area. It'll come back and tag into this point of control and then find price acceptance. If not, we can't assume that. All we can assume is that it's going to take the easy move. What's the easy move from this support? Path of least resistance is up to fill in that bubble. Then here's the thing, guys. You'll hear me talk about this a lot if you stick with me. We can identify the magnets, and those are our straight shot moves. Then we have to wait and watch what price does. Price was strongly incentivized to come back here. Price could, at this point, find new buyers, new accumulators. It could start building a base here, dip back a little bit, and then surge higher and break this bearish pattern. So you can't just trust the pattern. You got to watch the price action and the volume together. So it's probably going to say something else. I don't remember. I think that's pretty good for this slide here. Alrighty. Thank you, Steve-O. From one Steve to the other. I appreciate that. All right. And Brendan as well. Awesome. Brandon, I'm sorry. You know, VWAP Trader. Yeah, awesome. He's such a great follow on Twitter. He talks so much about. He taught me the concept of inventory, in a way that with those terminology that made it click a little bit more than my foundation. So yeah, big shout outs to him. He's a real cool dude. Yeah, go check out that interview on YouTube too. It's a fun listen. So, like water seeking a level. Nomi, this is what I'm trying. You're getting it. This means I'm doing my job. It's literally just the natural flow of things. When you're trading well, you are just in flow state. You're in sync with the market. You are seeing things in it just makes sense, right? This stuff just makes sense if you're able to conceptualize it correctly. And the thing is that it won't always make sense. You'll have setups and you don't get what's going on. That's when you don't trade. It's really that simple. And this is another big concept. I know it's getting into psychology and we're all over the place, but it's this is the only job in the world where you could make your wage in the first hour of the day and then keep working all day and give it all back. If you work at McDonald's and they say, hey, I know you've only been here an hour, but we'll pay you your full shift and you can leave. Would you like to keep working? And I don't know, maybe we'll try to take it back from you. Of course, nobody in the world would say that. So treat it like a job. Take the easy moves. If you don't see an easy move, don't stick your hands in the machinery and just, experiment just to see if you'll get hurt, like don't touch the stove. Stick to the easy moves and you won't get trapped. And if you do get trapped, well, then you know where your risk is because it's an easy setup that you've done a million times. And that is the big thing, that it takes the sting out of losing because it's not your fault. You did the analysis and it doesn't always work. If you didn't do the analysis, well, then yeah, it's your fault. You have some work to do. Don't beat yourself up, but that's a problem that you are aware of is great. It's something you can fix. So I really want to frame this in this way because it's so easy to get demoralized, guys. This stuff's so hard. You might be new and I'm just throwing way too much at you. And you're like, oh, well, it makes sense when he's doing this right now. But if I tried to do this on my, I would have no idea. That's okay. It'll come with time. This is way more than 10,000 hours of screen time. So be kind to yourself. This is hard. Yeah, no, me. All right. We are I'm picking up what you're putting down. It's always okay to be wrong when coming from a place of education. And this is something I'll say constantly. This is one of my favorite sayings. It's okay to be wrong. It's not okay to stay wrong. If you know you're caught in a bad trade, if you know you're off sides and your ego won't let you close that trade, that's the number one tendency that will ruin accounts, that will just shred people's accounts and their confidence. So if you don't take anything else away, take that away from this. It's okay to be wrong. Everybody's wrong. I was wrong like 4 times today. I had a really bad day, guys. I had a really bad day. I had 150% trade. And just because I missed a trade in the morning and I was tilted because of that, and then just because I took the 150% and it went on to be like 500%, I can't control that. I made good money off that. But I was tilted and I took bad trades and I lost money today. Still a really good week. So I got to keep it in perspective, right? I got to be kind to myself and punish myself a little bit, slap the wrist, but we got to look at it week to week and month to month. Are we making progress? So today I was tilted as heck, but you know what I did? I shut it all down after I realized late, but I still shut it all down and I'm not going to carry that into the next trading week. So that is correct. Naomi, once again, if experts were never wrong, we'd all be rich. So there we are. Let's power through the rest here. And then if you guys have any more questions, I know I've been going a while here, but I'm having a good time. So this is the fun part. This is what I wanted to talk about, the high probability setup. So excess patterns, they're great. So spike formations beyond value. These look like a rejection of previous highs or lows very often. And they look like those moves that we can fade very repeatedly when they're out past, when buyers are out over their skis and there's no structure for them to be bidding this high. You go, I'm calling BS. I'm going to fade this because I'm seeing weakness start to form above the value area high. I'm seeing that spike start to form. I'm seeing high volume, but not follow through in the price action. So that will often mark a turning point. And that's what I have to say about that. Actually, let's go back. Let's look at this a little closer. So excess spike patterns like this one down here is one that you can look for. So this is, whoops, thought I was drawing. Let me fix that. You guys can see my cursor bouncing around there. I'm trying to get it on my virtual monitor. Where is it? There it goes. Okay. Struggle bus. So spike formations beyond value. So there's our value area low. We see these spikes and failed auctions twice. That's a good sign. It's also worth noting that see the first wick here? If we draw that out as a zone, a little box like that, that should represent an area of institutional interest. As long as this is holding, we can assume that price will eventually want to gravitate back up and clean up some of the structure. But these spikes below the value area can be great because you can play them as little mean reversion scalps. While you're waiting for this sideways action to play out, you can take it back to the point of control. Still a good trade. But what you really can be doing and should be doing, so you take half off there, it pops it. Well, look at that. I have a clearly defined risk level in profit. Perfect trade. Any trade that you can free roll your risk is one that you should be focused on. So that is why I love these high probability excess patterns for entries or exits. So here we have the high up here. Worth noting that we just surged up to a major high. We cleared out all the stops here. And this action right here is the digestion of stops getting stopped out, or shorts getting stopped out. And then there's going to be some new ones trying to step back in. And then there's going to be buyers who are trying to hold this previous high and just get straight expansion. You don't often get just straight expansion like that after you clear, you impulse move to a major level. Almost always there's going to need to be some digestion there. So when remember, we're all about finding the accumulation, catching the expansion, selling the distribution, waiting for the next straight move. So that is our trade. We get out here and we wait. And if you're still bullish, you can pick your spot. And you'll probably get stopped out if you're still bullish after a major impulse move to a major target. But that is on you. So what you can also do is look up here and look for the fade. You can say, I missed this, but it's running way too hot. I think this needs to cool down because this is just too much too fast no matter how bullish we are. So you look for the value area high. And hard to see because of my line, but it does tag an instant rejection. That's a pretty darn good sign. So instant rejection, you can wait for it to lose VWAP. This would have chopped you a little bit. Wouldn't have been a very easy trade, but what how I would frame it is, okay, it comes back down and it doesn't break the value area low, probably not ready yet, but on this back test, you could get involved with a stop over the value high because it should not have to go there again if it's gotten enough liquidity. Sometimes, actually quite often, it will make a double top, right? So it'll make the impulse move, and then the path of least resistance after it comes back to the support that it pushed off of from will be to come back up, and maybe it can run the stops from the first high. Maybe it's a higher high there and it's a big trap there, and then it becomes a false double bottom, like a false break double bottom, or double top, I guess. Sorry, we're talking about topping. But very often it will make a lower high, indicating that buyers could not expand further and that this is capping the top of the range. And these are the times when it makes that second peak and then it comes back and trades through whatever whatever it is, point of control, whether it's a value area high, if you're aggressive, point of control if you're safer, a key moving average, whatever it is for you, VWAP. That's how you can frame that trade and catch the really straight move without having to worry about it reaching liquidity and losing point of control and then running your stop again, because that sucks. And it will happen a lot if you just do this on the first touch. So maybe you short there, you take half off at point of control. Or if you get down to near value area low, you take it there. And then if it comes back up here, you have your stop over the highs. You get stopped out and you watch it reject again, then you can say, okay, I'm going to do the same thing again here, because you should have made at least a little bit on the trade, or at least small stop out. So that's kind of how I would frame this here. And let me catch up on some questions. Nomi, you would be correct. Yeah. I hope you joined my Discord. I think we have a lot to talk about. Good vibes. So yeah, you can find that on my Twitter bio at STEVETEILMANN at twitter.com or whatever. Okay, so Q Trader. It's a combination that makes it hard. Technical analysis, position sizing, risk management, mindset. You need to combine them all together. Absolutely. Absolutely. And some matter more than others. I would argue risk management, number one. Position sizing, obviously a large part of that. And mindset, number two or number one. Those are the top two. I will be completely honest with you. My job is not that hard when I'm just a technical analyst. It makes sense to me. I think anybody can learn this. What's really hard is you're trading against yourself. You're trading against your own emotions. You're trading against all of those mean hedgies who wanna mess you up. It's just keeping equanimity in the face of bullshit is important when you're trading, because there's a lot of bullshit. It'll mess with you. It'll run your stops. It'll come back and take your money, and then it'll shake your pockets and run it right back the other way. And if you can't take that in stride, there will be problems. But if you can, then you learn how to capitalize on those moves. And those stop outs you were taking will become your entries for snipes. And not a better feeling in the world. You guys know what I'm talking about. You catch the wick down, you look 2 minutes later, you're already nice in profit, put a stop under the low, easy peasy, stress-free money. That's what we're after here. So let's see. Tony's saying, okay, this bread and butter, this makes more sense. Yeah, this one I think is probably where I would start, and honestly where I would hone things back down to. If you feel like there's too many setups, too much going on, if you want to just get back to the basics, fake breakdowns, my guy. It's just so good. It's just so good. I'm just plugging everybody today, but Adam Mancini, another big person in my trading journey, he only trades failed breakdowns. He kills it 2 to 5 times a week, every single week. So all you need is one good setup. One good setup. Okay, RV saying, I see those little bounces off support. Do you wait for it to hit resistance to get out, or do you wait till definitely not going to push through? In this example here, if we were shorting the loss of the value area high, is that the question there? So you're asking, okay, if when it runs back up on you here, do you wait for it to sweep the high? So what I would say is that topping processes are often more messy than bottoming processes, which is why I prefer failed breakdowns to failed breakouts. Topping processes often need multiple times as it cleans the tape up, as it filters out new bulls who are trying to buy the dip when the dip ain't going to dip, or it's going to keep dipping, I should say. So they can be messier. When you have a clear zone of interest down here, it's often as simple as, well, there was no bid, no bid, no bid. Oh, huge bid, big resting order, big iceberg order, as you'd call it. So that can be a lot cleaner. But even then, in this bottom, we do have some multiple runs here. So that's why for a failed breakdown to be valid, you do have to wait for it to reclaim the point of control, key moving average, previous day's high, neckline, something that you need to believe in, to have confidence in being a point of interest on the charts. Does that make sense? So for this one in particular, if we are waiting for a confirmation on the loss of point of control, it would look like this failing to push higher and then surging back down and then back testing right there. Back testing and failing. So that would be the clean entry. And what you would do there is say, okay, now it's pushed up once, twice with a lower high. It shouldn't go up here. It has no reason to reach up here because it already tried a second time and it failed to find buyers up here. So if it failed the second time, you can assume that that high is going to hold. And so that is the high probability trade there. Does that make sense? Yeah, Mr. V, I love it when it works out. I was hoping it would because I was finishing this up last night, finding some pictures, and there was the beautiful P profile that I was already watching because I traded it yesterday. So I thought I knew what SPY was going to do. I had a good feeling. So, happy accidents. It's nice when it lines up like that. Can I explain the difference between market breadth and market profile? Yeah, so market profile is the actual indicator of like on the side of the screen kind of thing, showing where price is transacted. Usually market profile refers to TPO, which is time price opportunity, and that's the one which will look very similar, except for it's going to be with like little A, B, C, D, E, F, Gs to represent the different half-hour sections of the day. And that is now paywalled to my level of TradingView subscription. So I actually don't have access to it right now. I need to upgrade my subscription, I guess. But I use volume profile almost interchangeably. For me, it's good enough. I know some people who live and die by TPO. They're nerds, but that's okay. I respect that. Anyways, market breadth. The breadth of the market describes how many stocks are participating in the rally, for example. So if a market has tight breadth, it's only going to be pushed up by maybe the mega caps or something. It's if there's a wide breadth, everything is going to be getting involved. There's going to be more money rotating from these different sectors as they set up and break out and contract, and that kind of thing. So at least that's how I conceptualize those two terms. Yeah, Mr. V saying, one thing I've learned is to place my entry where my stops would be. The average retail trader enters the market prematurely. Yes, because we see the writing on the wall, but we don't understand the mechanisms in which the market creates opportunities to safely enter those situations. So we jump the gun and then we think we're wrong. But we're not wrong, we're just early. We're Michael Burry, we're just cooking, we gotta stick with it and hold through 50% drawdown like him. No, I'm kidding, but it's that kind of thing. Yeah, Black Mamba saying, I'll wait for the second or third stop sweeping, and then he likes to enter. Perfect. Today was a perfect day, an example. Big wick and go. Yes, sir. Yes, sir. You get it. Absolutely. Good stuff, guys. What would you say about Adam's acceptance? Adam Mancini's price acceptance? Is that the concept here? Assuming it is, I would say acceptance means prices, accepting at the level. What does that look like? It means that sells into this level are going to be weaker and weaker, and buys are going to be stronger and stronger. The dips under the key level are usually going to be shorter and shorter as buyers are more willing to bid up the anticipated breakout, because there is a consensus between buyers who are stronger than sellers and sellers who are noting this, and they're saying, okay, all right, we're going to step out of the way. Okay, this is starting to kind of move, in that direction. It's finding acceptance at the level. So rejection of the level would look like sellers piling in and active selling. If anybody uses Bookmap, it's such a great tool to visualize this, because you will see price coming up to a big old red level on the Bookmap, and you will see bulls trying to eat into it, and literally they'll be eating into it like piranhas taking little bites out of this big steak. And if the bears are strong, they will slam it down, and you'll see active red bars pushing it down. That's active selling. That's a rejection of a level. If there are passive sellers, it'll look like that big red bar is just getting eaten, and eventually they pull it and say, I'm done getting beat up here. You guys have your fun, make your move. And then it's a imbalance of buyers to sellers, because the sellers just left the market. And then you get the expansion. So that's a really great tool for visualizing this concept. But you can do this looking at candles too. If you see jagged moves down from a key level, that shows you that there are active sellers there. If you see buyers pushing up and then a little bit of pull down and push up, a little bit of pull down, they are cooking it. They're cooking that level. It's a war of attrition, and they're winning, because if they weren't winning, there would be active sellers. That is what I would say about that. Yeah, Black Mamba gets it. Big circle. Mamba, do you have the little boop 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 boop? I have the little bubble sounds, and it's like it like soothes my crazy mind. It's like, oh, I hear it coming. I can hear it coming. So yeah, great tool to visualize, and also you get the audio tools. It's awesome. Alrighty. What else? I saw a question about Q Trader asking about AI. Did you ever use AI in your trading toolbox? Wouldn't it be crazy to put your thought process into an AI? I use AI a lot. I think we're at this cool place societally where there's a big mismatch. There's a big imbalance in the labor market, where you have the opportunity to leverage your time in a way that you never have had the chance to before. I am so much more productive with AI. Never going to let it trade for me. I don't think so. Maybe Probably, but I don't feel like I can yet. I want to be in control. It's an ego thing. If I said that in front of Michael Noss, CMT, uh, who is the one of the hosts of Trade the Pool, which is another great stream you guys should watch. If I told him that, he would say, "Get the hell out of here. You should have no emotions. You should be a mechanical trader." And he's been doing it 5 to 10 years longer than me. He's a better trader than me, so he's right. But I still got, I haven't, I still have some hope left. I haven't gotten it crushed out of me quite yet. So I think I need to handle my trades. But let's see. Yeah, Nomi, absolutely. I cannot code, but I can make all the indicators I need. That's pretty cool. That was not something you could do a few years ago. Vanna, absolutely. I'm going to do a whole webinar on Bookmap because it is an amazing tool, and I believe Trade the Pool is partnered with them in some capacity. I do have to double check on that, but amazing, amazing tool. And if you have Thinkorswim, it's free for for ES. Which is all you really need. Let's be honest. So let's see. All right, do I have more to talk about? I guess I do. All right, guys, we've been going a while. I feel like I've given you a lot to chew on here. I think we're going to wrap up questions, or we're going to work through these questions. As long as guys have questions, I'll answer them. I'm here to hang out, but I think we have enough for next time. That we're going to make this a two-parter, like I was saying. Like I was saying, there's a lot to talk about here, right? It's it's fun. It's fun getting into the examples and actually going through trades. So if you guys have any trades you would like me to look at or possible setups you'd like me to look at, any other questions, feel free to start dropping those in. And yeah, we'll take it from there. Mr. V, yeah, thank you so much. I appreciate you coming on in. You're more than welcome to come on in and trade with us in the Trade the Pool Discord server. You can find that. Tim will post a link, I'm sure. You can also come to my server as well. That's in my Twitter link. And yeah, great people in both, proficient traders in both, who are there frequently and there to answer questions. That's the biggest thing. They're both focused on education, free education. So yeah, that's where you can find me, and you can pester me with charts, and I will love it because that's what I'm all about. Yeah. So yeah, that's where I'm at, guys. What you got? Any questions for me? Yes, sir, RB. Thank you so much for coming on in. If you like my teaching style, go out and check my other webinars on that playlist at Trade the Pool's YouTube channel. And if you want to get more in depth, I do one-on-one coaching too. My students have a lot of success. They're happy. They outtrade me sometimes, and sometimes I get jealous, but not really. I'm proud of them. It means I'm doing my job, and I still have a long way to go for the actual execution. So that is one thing. I will be honest with you guys. I am an analyst first and foremost. Pushing buttons is hard for me. I get stressed out. I don't trade my plans. I get stressed out when alerts go off like that I'm not expecting. Let me turn that off. Guys, I don't know where it's coming from. I'm just going to close the little window. There we go. Okay. All right. I don't even know if you guys could hear that alarm sound, but okay. Yeah, Mr. V, start an account. There's super great ways to limit your risk, and that's what you need when you're starting in trading or even intermediate trading. If you're not consistently profitable, it's a great way to keep it real, keep skin in the game, because paper trading isn't the same. Everybody says go paper trade. You paper trade for a year and you hit real money, you'll feel very different. So, got to have some skin in the game. Evals are a great midpoint there. Black Mamba, yeah, app, absolutely. It's a beautiful one. I don't have to look at it. I know exactly what it's doing. I'm not in it. It's a runner, but yeah, beautiful. I can pull up the chart though. RB, yeah, a whole lot of the second one, none of the first one, but oh yeah. And time away from the charts, going out and touching grass, guys. The best thing you can do for your trading is not always be at the screen. That's a huge one that I have to learn better. But all right, guys. I'm gonna get some more water. I'm gonna use the restroom real quick. I will come back and answer any questions that you guys drop by then. Then we're going to wrap it up because it's been 2 hours, but I appreciate y'all very much. All right, I'll be right back, guys. All right, we are back. We are so back. All right, Mr. V, I didn't mean to. You know what you're talking about. You know what you're talking about. But still, evals are awesome. I still trade evals. I'm trading my Roth, options gamble account, evals, trading it all. Trading it all. Yeah, paper trading, playing Texas Hold'em with fake money. Yeah, I'm all in, baby. I'm all in, baby. Send it. It's very different. Very different. It is pointless. I agree. It's not. All right, let me. It's not pointless. You need screen time before you trade your real money. A lot of traders spend too much time paper trading when they should just get their hands dirty, make some mistakes. That's what life's about. I really do want to emphasize this because it'll separate the wheat from the chaff. Sometimes I'll say this and people are like, I don't want this. You got to be okay with paying tuition. You are going to lose. You're going to lose. If you stick with it, you will pull through and you will become consistently profitable and it will be an amazing career for you, but you're going to lose. I don't know a single person that I respect deeply as a trader that didn't blow up an account. I can't think of a single one. So just keep that in your back pocket. Don't beat yourself up on a bad day. Yes, I'm talking to myself. My options account's down 10% when it was up 25 yesterday, and I feel like a dummy, but end of the week, I'm up 20%. So that's the takeaway. Be kind to yourself, guys. What else? What else do I got for you? I've been told I should be using leverage. Is that the only way to make higher profits? Lever up, baby. Bill Hwang, 500x or nothing. No. Leverage is the number one thing that blows accounts. You don't need it. If you can trade, you can do it with one share, It's you will succumb at some point to the very human condition of big number go burr. It's very insidious. Anecdotally, started out as an options trader, made amazing returns, gave back puke-worthy returns. Did that a few times before I said, I can't handle this. I'm too old for this shit. It's like that meme. It's like scalping every day. Will it's a stress-free and relaxing way to make a living. And then the picture is like Steve, the options trader, 25. It's like some 80-year-old guy. You will age rapidly if you do this kind of shit. Trade shares, pick your spot, don't chase. It's so much easier. Don't mess with leverage until you know you can handle leverage. RB, that is okay. A lot of really good traders have an under 50% win rate. If you're shooting for that risk reward, you're looking at it the right way. That win rate will bump up. Just keep on grinding, brother. Just keep on grinding. Probably stay away from leverage for now. Not because those are bad stats, just because you already lost all your hair. Yeah, stay away from options, dude. Stay away from leverage. You don't need it. When you want it, when you grow your account, then that's good. What I did for the first couple of years is I would gamble. I like gambling. I'm a gambler. Gamble with options, make some money, throw it in shares, throw it in an investment account, compound the investment account. Never keep too much money in your gamble account, especially if you're a gambler. So I'm not saying I'm the best trader or the best at any. I'll give it to you straight. That's what you can always expect from me. So, all right, guys. Tony making money while we're hanging out. Good shit, brother. Love to see it. Thank you guys. All right, I'm going to start wrapping it up here. Any other questions? Get them in now. Beat the buzzer here. Get your orders in, your mock orders. But I think we're winding down. I think it's been a long week, and we have some stuff to think over, right? I gotta go. Right. I will follow my rules 100 times on a chalkboard. Whatever it is. Whatever it is. All right. So, guys, this has been fun. I appreciate all the new faces. That means a lot. It really does. So please come find me on Twitter, on my Discord, on Trade the Pools Discord. We are here. We want to help you. We are giving back because people were so kind to do this to us, for us, not to us. So yeah, come on in. It's a good environment. We don't bite. And we're going to be hitting it hard next week. We got some good setups. So everybody have an awesome weekend. I'm going to go out and get some fresh air. Looks really nice outside. I hope you guys do the same. Take care. And I will see you guys Monday, or if you're waiting for Trade the Pool stream, I'll see you Wednesday. And if you're waiting for a Trader TV stream, I'll see you Friday. But you know where to find me. Have a great week, guys. Take care.